So next week we get tech earnings. We also get the Fed. Economists now expecting the Fed to raise rates at a quicker pace through 2024 than previously thought. And that's according to a recent Bloomberg survey. Greg Branch, Veritas Financial founder and managing partner, says the Fed could start a change of course as early as next month. Greg joins us now. Greg, does that mean that you're looking for Jackson Hole to be somewhat live in some capacity?
Oh, I am. And I think that they might even start the body language towards that next month. You know, the issue that's being exacerbated by the variant is that the supply chains may be broken more acutely and for longer than we expected. And if that's the case, the inflationary pressures that we're seeing will continue to build. So I do expect them to address the second of their mandates, the one that they've largely left untouched, when we get to Jackson Hole.
Is the market priced for that?
I don't think so. I don't think so. And the yields, the current yields we're seeing would agree with me. You know, we started to see yields lift into the 1.6 range back in April and May as the inflationary pressure started to build in anticipation. But the market has largely listened to what the Fed's been saying, and they've been resolute about their narrative that this is transitory.
So if that's the case, when you take a look at, say, the PMI data today, and I understand we don't pay attention as much in the U.S. as that in terms of the market PMI, but it really does imply that we've seen the top and that growth has already kind of topped out. Right. How does that square with the Fed that you think may start to become a bit more, not aggressive, but persistent?
Right. So, you know, the question about growth is an interesting one, and I think we'll need more data. If the variant continues to spread at its current pace throughout our supplier countries, if they are not more, they don't express a greater urgency around getting up the vaccination curve, then we could very well see growth slow in the back quarter. I'm certainly downgrading my outlook. When you look at our supplier countries, we've got Taiwan at 0.5% in terms of vaccination rate. We've got Thailand at 5%. We've got Mexico at 17%. Some of these economies are in the process of or will be forced to close down and retrench in order to deal with the spread of the variant. And again, that's going to affect our global growth outlook. And so it's something we have to keep an eye on. We don't quite know yet, Alex.
But Greg, does that mean that we're going to see the resurgence of the U.S. exceptionalism? Because if you look at the resurgence in COVID cases here in the U.S., they're happening in states that don't have as much GDP as the states that do.
Right. I think that's a fair point. To some extent, yes, the variant will impact us less. The major impact that we'll see is that we'll continue to see wage pressure to the upside as businesses compete for a dwindling pool of workers, be that through fear or be that through infection. Now, that will be somewhat offset by the natural lowering of the unemployment rate as people go back to, as their children go back to school, as the unemployment benefits roll off. And so, you know, it may keep our worker pool stagnant, which will force some inflationary pressure, but that's really the extent of the impact that we'll see here. It really will be driven globally by whether or not we can get our supply chains back on track.
How long do you think that takes? What does transitory mean to Greg?
So, the primary issue itself, I would hope we are through by the end of this year. The effects, the inflationary effects, though, I think will be lasting through all of 2022. At the end of the day, we will have the mother of all restocking cycles eventually. But if the economies are closed down, if the supplier country, if their processes are closed down, it's going to take us a while to reestablish those, and then it's going to take us a while to get through the psychological effects and these almost self-fulfilling prophecy of inflationary expectations. So I'd be prepared to deal with this for about a year. Okay, and that, you know, for some people, a year is definitely not transitory. The market, moving on that, I mean, you look at ETFs that are focused on value stocks. They've seen about $2.2 billion outflow so far this month. Do you think the value trade has more to wring out, and where do you put that cash? Yeah, you know, look, I think in a world where, you know, those who have hard input costs, those who are very dependent on labor costs, and you know, we're seeing most of the wage inflation at the mid to bottom end, Those are precarious places to be, right? And that encompasses a lot of value. Less so with tech. If you believe the Fed and they're not inclined to act anytime soon in terms of their monetary stimulus, and certainly they're less impacted by the competition for workers than, say, restaurants are, and they're certainly not subject to food cost inflation the way restaurants are, tech presents something of a safe haven. Plus, they are blowing away the narrative that what we saw last year was a COVID-related bump or a COVID-related pull-through. And many of us expected that we'd be in a cycle for much of the tech names.
Fair. And that's what was so surprising about Twitter yesterday is that, returning to the pre-pandemic growth ad world is very much possible. Isn't that already, well, I guess what part of that story and where is it baked in and where is it not?
Yeah, I don't think that this is priced in at all. I think we're going to have to lap third quarter results because that's going to be a very challenging quarter in terms of compares. But I think we'll need to, you got to remember, first quarter didn't have really difficult compares, and to some extent second quarter didn't either. But when you combine second quarter and third quarter, if they put up good growth numbers, and this is not just about Twitter, this is about the cloud, this is about hardware, if they put up good growth numbers in the third quarter as well, I think we will have all but killed the narrative that they were experiencing temporary bumps or transitory bumps.
All right, Greg, thanks a lot. I really appreciate it. Next week, we'll be extraordinarily busy. Greg Branch, founder and managing partner at Veritas Financial Group. All right, coming up, it's a warning to Wall Street. An ETF that's tracking big banks is seeing its worst outflow since the financial crisis. I mean, really, that was the bond bull in charge. This is Bloomberg.